Okay, okay, right. Hi, everyone. We are delighted that you could join us today. My name is Samantha Taylor, and I'm a research manager here at iFi Global. This is the second online event we have hosted since the launch of our new Atlantic Fund Intelligence Unit. Now, AFI is primarily for US managers and their advisors who are looking for help with their selection decisions when considering expanding into Europe. Today, we are presenting the results of our research that we've conducted with US managers and their advisors um, on their selection decisions for Europe. We are delighted to be joined by Chris Addy, who is the president and CEO of Castle Hall. Castle Hall is a major operational due diligence company with global institutional investors as clients. They have conducted due diligence on approximately 10,000 funds and asset managers across industry. But before we get to Chris, Simon Osborne, our CEO, is going to present a brief summary of the findings of our research. He will then get into a Q&A session with Chris before opening this up for questions from the audience. We do really welcome your questions. So please do, send them in to us through the Q&A button at the bottom of the screen. We anticipate leaving around 15 minutes for that at the very end of our session. But I'm pleased to say that the full results of our research will be published in next month's issue of FSI, and we will be delighted to be able to send this to you all. We will also be announcing around that time further online events covering topics mentioned in this survey. So I will now hand you over to Simon.
Thank you very much, Samantha, and thank you everyone for joining us today. We are very pleased that some of the people following this thing that we're doing now participated in the research study itself and are here. And I know that there are a lot of people who couldn't make it, and we've promised to send them a recording of this discussion. So to both of you who are here and to the many of you we hope will be seeing this in the next few days or weeks, thank you very much indeed for participating in this research study. It is very much appreciated indeed. My name is Simon Osborne. I am the CEO of iFi Global, which is a research and media house based in the City of London. We have 3 monthly publications and 1 weekly. FSI, which is one of our monthlies, is primarily for US managers looking for independent analysis on what to do when going outside the US, going overseas and primarily to Europe. And through FSI, we, as Samantha just mentioned, we have just launched our Atlantic Fund Intelligence Unit, which is a kind of consulting unit and gives FSI subscribers advice on the selection of service providers, mancos, fund directors, distribution options, fund domiciles, all as part of their subscription to FSI. As Samantha mentioned, details of the study will be published in July's issue of FSI, which we'd be delighted to send you. So I'm not going to go into spend any time going into the sample, etc., in any detail right now. I'm just going to go through the broad brush main points. But I will say, with regard to the sample, we actually have, in a sense, which is very unusual for us, 2 different samples, subsamples. One are the US-based managers across several different strategies who participated in the study. They are primarily alternative managers, particularly those in illiquid alt strategies. And then separately and aside from that, we have interviewed a good number of the leading New York-based law firms. We focused on those that do not have offices, as some of them do, but we focused on the ones that do not have offices in either Dublin or Luxembourg, because we didn't want any bias in terms of the responses from them. But several of the firms we did speak to do have offices in London, but that will not affect the research results. So if you could switch to the first slide, Samantha.
Yeah.
So let's start with what we discovered on US interest in Europe. First off, I should say that our manager sample, not the lawyer sample, but the manager sample does, if you can call it, suffers from selection bias, because those people who were happy or willing to participate in the research are the ones who have an interest in Europe and or are looking to get into Europe, haven't already done so. And those that declined to participate in the study for obvious reasons are the ones we were not able necessarily to pick up. We would like to ask them one day why they're not yet interested in Europe, but we didn't get them into the body of this research. So bear that in mind as I go through these results today. So 44% of the manager sample that we have as part of this study already do have investors in Europe, and the others, in the manager sample, are, as I already said, are interested in getting investors in Europe and are interested in looking at the region. Perhaps a more accurate number, if you want to put it like that, in terms of what is the overall US, particularly alternative or alternative asset management market interest in Europe. And that is probably, according to and it's an estimate on behalf of a number of law firms, some of the, if not the largest in the business, they estimate it's about 35% of their client base. So it's just over a third is probably a reasonably accurate description of the overall market by numbers rather than by size. And as all the lawyers we spoke to said, it is increasing. They didn't say it was exponentially increasing, but they said it's slow and steady, but it's definitely increasing. So if we can turn over to the next slide, Samantha. So why Europe? One of the first questions in the research. Europe is seen, which we didn't know at all really before doing this study, by US managers, and also repeated in the lawyer sample, as being less crowded as an opportunity for them in comparison with the States. We were told on several occasions fundraising in the US is difficult at the moment. There's an awful lot of managers in doing the same things and the same strategies. And the view, correctly or not, I don't know whether this is the case, correctly or not, there is less competition, perhaps, for managers in Europe. And what we should do, and it's a sort of only a thought that's occurred to me since I was looking at the results of this research, is that we should try and at least do some research for FSI on that, to look at the number of European-based managers and to the investors in comparison with what the figures would show in the US. If that's possible, that would be interesting to see. But it's undoubtedly the view by many in the US that it's less crowded than it is back in the States. There is another major reason why Europe is of growing interest is the European family offices, we understand, are very active and increasing their allocations to US managers at quite a fair whip at the moment. And of course, European institutional investors are also allocating substantially to the US market as well. It's worth perhaps making the point as we go along here that there are a lot, and maybe not perhaps well understood by a lot of US managers, really substantial numbers of European family offices dotted all across Europe. Many of those are family offices representing money that goes back many generations indeed. And I will add that if we get into political chaos in Europe, which many think we are on the cusp of doing so, then those allocations to US strategies are likely to increase and to increase substantially. France, where I lived for 6 years, is said by many people to be potentially on the verge of chaos. We'll see what happens in the course of the next few weeks. But certainly, there is no reason to think that the European families are going to sit on their hands if things go from bad to worse on the sort of macro stroke political level over here. The third point on this slide is absolutely fascinating, and I hadn't heard this before, but it did come up very substantially in one interview and then partly in another interview as well, is that apparently one of the larger mancos has been going around the US, having done their own research, showing that European investors have lower return expectations than their American equivalents. I don't know whether that's true, as I'm just repeating now, in effect, third hand, some manco, I don't even know which manco it is going around the US market telling people that is the case as a way of getting US managers to come over and try their luck in Europe. It's plausible, that's all I can say. In the ultra competitive, more competitive, perhaps US market, the expectations perhaps for returns are higher than us lowly Europeans, where we will just accept what we get type of thing. Of course, the other reason why US managers want to come here is, of course, it's a very good diversifier of their investor base. Next slide, please, Samantha. European markets. This is in the order of mentions from the research, both the managers and the lawyers. I think it looks to me, from my perspective, to be reasonably accurate. The UK first, Switzerland second, then the Nordics. There are 4 Nordics, Germany, Netherlands, and Italy. What's interesting is how rarely France and Spain were mentioned, once or twice only, 1 or 2, perhaps more in Spain than in France, interestingly enough, but very little in comparison with the other markets. Italy, definitely more popular than the other Latin countries in Europe from this sample anyway. And it's very well worth making the point that the UK and Switzerland, the most popular 2 markets, are not in the European Union. And it's also worth making the point that, and this goes on to the second paragraph on this slide, that Europe is not and never will be, certainly never has been and never will be, a single market as the US is, just because the EU has imposed the same regulations across the continent of Europe doesn't mean to say it's easier to market in a whole host of different countries at the same time. Each of these countries has, almost all these countries have different languages. There's about 22 languages in Europe, and they have different customs and different traditions. It really is worth emphasizing that think of Europe not as a homogenous bloc. It never has been and never will be. It's a whole host of countries with very different ways of investing in the same geographical part of the world. Next slide, please, Samantha. Distribution. This, to me, is the most surprising stroke interesting finding of this research. I had, when I first saw the results, I was thinking, is this really right, or is there a mistake here? But then when I thought about it further and discussing it with 1 or 2 lawyers, it actually does make some sense. What we're saying here, this is, by the way, very important point. We're saying this is by numbers, not by assets. If it was by assets, it will be almost exactly the reverse. So we're saying that 45% of the sample, or the 2 samples, are accessing Europe via the private placement option. An extraordinarily high number, 40%, not far off the private placement number, are doing it through reverse solicitation, and just the 15% going through the full AIFM compliance and domiciling in the EU. I say that's by numbers, by assets. If you were to look at the people who have domiciled in Luxembourg or Ireland and are fully AIF compliant, that would be where I would guess the bulk of the assets are being raised in Europe by numbers. This is just survey responses from this study that is giving this. But still, even having said that, it is a big surprise to me to see that private placement is as popular as it is. I think, reverse solicitation is as popular as it is. I think one of the points that was made to me in doing this research is that quite a lot of European investors follow portfolio managers around. So if a portfolio manager leaves investment management group X and joins investment management group Y, they will go with that particular manager. They won't stay with the investment group they were in before. So that is perhaps pure reverse solicitation in its purest sense. But also, again, this has been coming up a lot in the rails recently, in a number of conversations we're having. The advances in technology, and European investors, like they are everywhere else, incredibly sophisticated. They've all got their MBAs and their business school education, and 2 or 3 degrees, etc. It's the combination of using AI and the sophisticated databases that there are out there means that very often it is true to say these days, in a way perhaps it wasn't until recently, investors are finding managers more than the other way around. The days when you could do business primarily through bumping into people at a conference cocktail party, exchanging business cards, are, thanks to technology, are probably slowly coming to an end. So unsolicited approaches to investors are becoming ever more difficult, and it is being, selection of managers is more and more investor driven rather than the other way. And that means reverse solicitation, at least until the rules are changed, is possible for many US managers. I would say something about private placement quickly in passing, that it is particularly popular by investors in Northern Europe, which is where a lot of the most sophisticated European institutional investor allocation markets to alternatives are. Some of the Southern European countries aren't as easy to use for private placement, but the Northern European countries, generally speaking, are. And that, if you do want to do something properly, as opposed to going through the reverse solicitation route, that is certainly going to be a less expensive and certainly very viable option in comparison with going through all the hoops of complying with the AIFM directive and coming fully into the EU. Next slide, please, Samantha. Right, conscious of the time, I'm going to shoot through this as quickly as possible. We did spend some time in the research looking at, some people call them the third-party AIFMs, other people call them MANCOs, short for management companies, the third-party management companies. All the manager respondents we came across who are going into the European Union are using third-party MANCOs. It's heinously expensive to go and set up your own office and not use a third-party MANCO. Only the largest of the large managers will be doing that, and all of them have probably been established in Europe for years, if not decades. There's hardly going to be another large US manager who hasn't done it that's about to do it. So all the way the US managers coming over that do need access to the EU, I think pretty much universally are going to use a third-party MANCO or AIFM. The lawyers in particular were generally very full of praise for how the MANCOs have gone about making access to the European Union easier, and asking managers and the lawyers, what are the reasons for selecting MANCO X over MANCO Y? The point was made on several occasions that the larger managers will go for the real reason for them doing it in the first place, which is the regulatory help, particularly representing them to the Central Bank of Ireland if it's Ireland, or the CSSF if it's Luxembourg. And there's a whole host of things they have to do for that, and for operational reasons too. Those were the original reasons for MANCOs. They all have their investment relations teams. They probably don't need the distribution help in the way some of the smaller managers do. But the smaller and medium-sized managers in our sample were happy to admit pretty much all that they will go for the one that is most persuasive. This is the MANCO, in terms of offering them help with capital introduction and with distribution into the European market. I hear it's quite common that some manager will go and set up in Ireland or Luxembourg because that manager will have got a major investor from somewhere or other, And then since they've gone through the hoops of doing that in the first place for that particular investor, they obviously think to themselves, well, where else can we go in Europe to access investors? And they would like to work with a ManCo that can help them open doors in that regard if they don't have the IR teams, particularly with the experience to do it themselves. But of course, they still need the regulatory and operational help, and they also need a lot of help with the risk management, which we won't go into now. That's a whole nother subject for another day. The last thing I didn't put on the slide, but perhaps very quickly in passing, we asked them whether they prefer to work with a standalone ManCo than a separate administrator and a separate this and a separate that, or would they prefer the bundled option? It is very, very much the case from our sample that most of them, almost all of them, prefer, particularly the smaller size ones, but the bundled option where they can get everything, all the service provision they need under one roof, including, which is again another conversation for another day, the non-executive directors for their funds too. Next slide, please, Samantha. Domiciliation, rattling very quickly through this. The broad point is managers won't do anything they don't have to do. So if they can get away with, in terms of domiciliation, I mean, so if they want, if they can use that, and they almost all of them do have a Cayman set up, say Cayman domicile funds, and or in Delaware in the US, they will use it if they can. If they are required to go and domicile in the EU, then that's what they will do. And if they can, maybe if they can do what they need to do just through private placement, maybe they'll consider the channel lines. I put that point about there, EU is trying to align with Delaware. This is news to us, recent news to us, and we'll explore that more, but there may be some growing connection directly between the European Union and what goes on in Delaware that we can talk about sometime in the future. And an important point to make is that some managers do use both. I have some quotes here, which I'm not going to use, probably because of the lack of time we've got on those that are using that as examples. Please just believe me, we'll put this all into the full study, of course. I should just say in passing that within the EU, Luxembourg is preferred by US managers for closed-ended funds. Ireland's just very recently, in the last couple of years, tried to get into that market, but hasn't, we understand, been yet anyway that successful. But it is more generally popular for open-ended structures. Regarding offshore, almost to repeat the point I made, if they can, they will stay with what they've got in Cayman. But if they want to do something perhaps closer to Europe or in Europe that's not Cayman, because Cayman has had a bit of an up and down reputation with some investors in Europe, then and they don't want to go fully into the EU, then perhaps they're going to look to the Channel Islands instead of as a sort of halfway house between Caribbean and being within the European Union. I've waffled on, I think, for long enough, Samantha. I think it's probably time to get our Chris. Hopefully he's there.
Yep.
So shall we? Oh, hello. I'm on a bigger screen now. So let's try and get hold of Chris. And I will, whilst you're doing that, I will just perhaps make a point about Atlantic Fund Intelligence to say that, as I said in my piece just now, that we're very much trying to develop that unit to help US managers with their selection decisions, and all conversations we're having with managers are entirely confidential. Chris, welcome to the show this afternoon, or the morning where you are. Do you want to react to anything that I've said first before we get into anything else?
Sure. Well, first of all, thanks very much for the chance to be here this morning. And despite the British accent, I'm based in Canada, so I have a perspective of the North American side, but equally originally from the UK. And very happy that you were organising the technical side of this, because to make sure that it all worked first time. I think really we were looking to structure this both as a Q&A between ourselves and equally bring in other participants to really make this a very collaborative and bilateral discussion. But a couple of things sort of spring out to me, both from the specific findings of the survey, and more generally as Castle Hall conducts due diligence. And we have both European, North American, Asian, Australasian clients. So we have institutional investors, family offices, banks, wealth management platforms in all jurisdictions. And equally on their behalf, we are conducting due diligence on managers domiciled in the US, managers domiciled in Europe, European investors who are interested in an American manager and consequently looking for an access vehicle to enable regulatory compliant access to a particular strategy. And the list of acronyms for available structures and jurisdictions and domiciles is a very long one. But I think a couple of things sort of spring out in terms of when we both speak to our investor clients and understand some of their preferences, and equally when we're working with managers, GPs, conducting diligence and looking at potential gaps or areas of risk that could come through from their operational structure. I think, first of all, it's very worthwhile reiterating the fact that by far the largest markets for European allocators are the two that are not in the EU. So, as you said, obviously the UK post-Brexit, although who knows what will happen with the Remainers, Ramonas post the election next week, and of course Switzerland. And of course, many high net worth individuals, family offices, they may be domiciled in Germany, in Belgium, in France, in Spain, in Greece, wherever it may be. But of course, they may deploy their capital through a Swiss private bank or a family office that's domiciled in Switzerland, for example. So Switzerland can actually be a very helpful conduit and collation point for European capital that essentially provides an access point that is outside the control and structure of the EU. I think the second point that I'd raise is sort of really the AIFMD generally, and I'll stay very high level and perhaps a little bit anecdotal and perhaps just a relatively sort of light sentiment. And obviously the devil is in the detail, and there can be a lot of variation and different approaches to working with AIFMD. But it does always sort of strike me there is quite a fundamental difference between the way that the European Union has gone around regulation for alternative assets, be they public market hedge, private market, private equity, real estate, venture, private credit, infra, etc., as compared to the SEC. Now, of course, the SEC, given the decision of the judges down in the Bayou of Louisiana, have recently, New Orleans have recently, of course, kicked out the private fund advisory rule. But what the Securities and Exchange Commission had said was that, in their opinion, there were conflicts of interest in alternative asset investing. There was a lack of transparency for investors to be able to be aware of what those conflicts are, particularly with respect to charging of fees and expenses and accurate reporting of performance. And there was a lack of governance mechanisms internal to private funds, be it essentially a non-retail mutual fund, be they private hedge funds or private equity. So the SEC was really taking the position, obviously now rejected by Republican judges, but was taking the position that there is a lot more work to be done. And there are indeed some fundamental structural problems with respect to institutional investors allocating to alternatives, especially when they are pension funds with a fiduciary responsibility to the millions of end pensioners, etc. I think it's fair to say that generally the EU has taken a different approach. In many ways, AIFMD is a rule to make sure that Madoff can't happen in Europe, putting it very simplistically. But there is always that sentiment of how can I put this? We, the government, know better. So it is a very structured, focused way of creating a fund structure within the auspices of the AIFMD. And certainly, as we look at due diligence, there's some things that the AIFMD does very well, but equally, we think there are some gaps as to areas where potentially the AIFMD doesn't necessarily protect investors from operational risk, from fraud. But it's very much, well, this is what the rules tell us to do, and this is what we are going to do. It's a rather blinkered blinkered approach in certain elements. And I don't want to, oversimplifying here. Again, the devil is in the detail, but I think there is a difference there. And certainly, we speak with service providers in Luxembourg, in Dublin, and some of the other centres. And it very much is, well, we follow exactly what, for example, the CSSF, the Luxembourg regulator, or the Central Bank of Ireland tells us to do. And sometimes you can raise a question, well, what about this or this area on valuation or existence of assets or pricing or what a cash movement, what the case may be from an ODD perspective? And the answer is very much, well, that's not required by the rules, so therefore we don't do it. So it's not necessarily the case that it's a different approach to regulation and structuring, and it's not necessarily the case that going through a European onshore structure is necessarily going to absolve an asset manager from needing nonetheless to establish appropriate operational and business controls. Just as an aside, I was recently looking at a German venture capital fund. And venture is obviously, it's always its own beastie at the best of times. But on this one, we actually failed the fund from an operational due diligence perspective, largely because of a lack of compliance procedures. There was no chief compliance officer, there was no compliance manual, there were various problems with respect to, for example, a lack of documentation around trade allocation policies, a lack of conflicts of interest. And what we eventually got back, for example, was a copy of an employment contract for the staff, and that was where there was a provision against confidentiality, and that was presented as being protection against use of material non-public information. And going, no, that needs to be in a compliance manual, not an employment contract. But our client actually argued very strongly against us and said, well, Chris, that's just not required by BaFin, the German regulator. So you can't, our lawyers have confirmed that the manager doesn't have to do this in Germany. So therefore, your judgment that this has an unacceptable operational risk profile is incorrect. And that was actually their compliance officer. So it's quite unusual to have the compliance officer of a client arguing with us about a lack of effective compliance in Germany. But it's a good little sort of micro example of how things come together on the European side. And there can often be a little bit of, are we driving on the right? Are we driving on the left? Are we driving a Buick or are we driving a Peugeot? It can be quite different perspectives. Two final points. The quality and capability of the European service providers varies widely. Generally, I find the stronger providers are those that have a global presence and are active in the US, active in Asia as well. Standalone providers that only service European clients, again, I think might have a little bit of a narrower perspective and perhaps, not all the time, but I'm generalizing, but perhaps a little bit more sentiment to my earlier point of, well, we're going to do what the rules require and that is it, because that is what the government has told us is sufficient to protect ourselves from alternative investments. Or to have an appropriate infrastructure. Also, we are not fans from a due diligence perspective of some of the bundling here. So you end up with the same company as the admin, the compliance consultant, the AIFM, the depository. That's an awful lot of it's a one-stop shop, which might provide administrative convenience. But for us as investors, and particularly for myself as a due diligence practitioner, I'm paid to worry about what can go wrong. So I'm worrying about the one time in 500 where things do go south, and it turns out that, if the administrator is primarily relying on information that's given to it by its depository affiliate, it's marking its own homework. There is a fundamental disconnect there in terms of really bringing meaningful segregation of duties and effective control. So again, just because it's allowed under the AIFMD doesn't necessarily mean that it is best practice or conceptually ideal from a due diligence perspective. So for US managers coming into Europe, some of the marketing spiel about how, well, this is the way it's done in Europe, that's all very well, but institutional investors, especially sophisticated investors, establish a global best practice irrespective of jurisdiction. We're looking for aggregate standards, whether our manager is in New York, in Boca Raton, or is an emerging manager out of Hanoi, for example. Last question, the last comment I'd have super quickly. One of the biggest differences between Europe in terms of investor preferences and priorities as compared to US investors is, of course, ESG. with a slight twist in that in ESG, there is a very pronounced and preponderant focus on the climate change and the environment, relatively limited and much more limited focus on DEI as compared to the US. So quite a different perspective, and irrespective of what ManCo structure you've got, if you are a US investor coming into Europe, the typical institutional investor is going to be far more demanding and unyielding with respect to climate issues in your portfolio, and that is a direction and a direction of travel that is only going to continue. A lot of risks around greenwashing. Regulatory oversight. You're more likely to get dinged on greenwashing than you are probably on a trade or accounting or technical operational issue from a European regulator. And if you are a European manager also trying to sell into red states, that might become quite a conundrum to be able to successfully manage the very increasingly diverging viewpoints across different components of your overall investor base. So just a few comments from my side as I'm thinking about how American US managers allocate to Europe, how North American investors think of European domiciled funds, and then of course direction of travel from the other perspective of European investors thinking about access to US-based managers and the capabilities and skills they can bring to a portfolio.
Well, thank you. One thing I want to ask you about, which is we touched upon before this, before today, is whether or not, if and I touched upon it in what I was saying about the American market maybe be more crowded than the European market. If there are a lot of managers with the same strategy, pursuing the same things with very similar performance, can managers, do you think, with your client base, I know you're on the operational side, but nonetheless, we're talking about the investor allocation side as well, can managers distinguish themselves, if that's the right way of putting it, if they are able to show they've got a good, viable business with the kind of operational ticks that you can give them, that perhaps if there's two managers pitching for the same account, very similar, everything else, one has got a slightly more robust infrastructure. Is that a potential distinguishing factor?
I really think that the fundamental landscape that we are working in has profoundly and completely changed. The cheap money Goldilocks decade, or almost the 15 years of ZIRP, zero interest rate policy, it's over. The easy money has been made. We are now in private markets in particular in a very different environment. We're seeing capital raising enormously more difficult, especially for smaller, medium-sized, younger firms. There is a flight to quality, or probably a flight to reputational protection of the Blackstones, the Silver Lakes, the Thoma Bravos, the Apollos, the KKRs, the Carlyles. And really, there's only the CVC, EQT, Permira, but the preponderance of large private market houses is in the US. So I think really at this point, anything that an asset manager can do to demonstrate that they run a good business is a very helpful thing. Clearly, a good business ultimately will produce a better product, which in our industry is investment performance. But we are really seeing much more interest from managers when there is differentiation and a harder capital raising environment. So on the first instance, managers who are strong to really be able to focus and message that as a point of positive differentiation. And then equally for managers who have potential weaknesses to become more cognizant and proactive in remediating. The very last thing you want to do is have a good strategy, get an investor interested, and then you fail due diligence because it turns out you're, as akin to my German venture capital fund, you don't have anything approaching a industry standard, global standard compliance program. This stuff isn't rocket science. It's just really about running an effective asset management business. And again, on the European side, it can be quite varied, because I think you will have some investors who place, in my mind, probably undue confidence in the tick box of I have a fully compliant AFMD structure. Of course, the fun will start when a couple of them blow up, and then we all say, well, wasn't the AFMD meant to protect us from this? And then, of course, we'll find out potentially there were some gaps or weaknesses that could be exploited by bad actors. Again, remember, I'm paid to worry about what can go wrong. So that's the perspective I bring.
Is there a way, sorry to jump in, is there a way of for the industry, for investors, for your clients to have a demarcation or a recognition or a scoring, whatever you want to call it, between in some of these areas we're touching upon in terms of building the business, but the service provider selection they may have or not? Is it too difficult to do? Or would it be, since you're going into the AI world, you know, AI loves numbers and everything?
Well, I do think that AI is actually a game changer here in terms of really being able to analyze larger numbers of data. Now, ultimately, analysis of investment opportunities, whether that's investment due diligence, operational due diligence, or tax or legal, reputational, there is always going to be some art. Ultimately, it is still a relationship business. Are we comfortable with the ethics, the integrity, the skill, the sustainability of outperformance, all of those issues? But it becomes increasingly, as we become more institutional, it is increasingly data driven. And what we're finding is that certainly AI allows us to go into a Castle Hall. We currently have just over 7,000 GPs, managers, and funds under active due diligence coverage. And in our history, we're over 10,000. So we just got a lot of data. And to be able to apply AI to that, also use AI to model and scenario test funds that have blown up or have had operational problems and losses in the past, and try and start to connect some of those dots. We're seeing quite a powerful mechanism going forward, and that works as much for US managers with the Delaware fund or with a Cayman entity as it might be for a manager going through Jersey, Guernsey, or someone who's onshore in Lux or in one of the other European jurisdictions. So I think we will be getting more scoring capability that really is starting to move away from traditionally due diligence reports were the opinion of one individual, and that might be a very skilled individual who's seen a few hundred. But the data that can be brought in with the technology really is deploying a lot of new techniques and capabilities. To your earlier point, Simon, I mean, there's just so much information out there in terms of searching and sourcing managers, funds, strategies. It is becoming so much easier to use tools, whether it's a Preqin, whether it's a PitchBook, whether it's an investment, all of these databases, other sources of databases and iConnections, etc. There's just so many more sources of information that then can be run through data using AI. And from a manager's perspective, again, it's am I meeting the requirements of the local jurisdiction? Am I aware of the preferences of my particular target investor client? And then, of course, am I equally meeting global standards for the next client that may come along? One thing that we've seen in Europe certainly is the case of, on occasion, a US manager will have interest from a single large investor, one of the Nordics, one of the big Dutch pensions, something of that nature, and they may have a particular preferred structure. Some of them really like managed accounts, for example, or a particular structure with a particular AFMD, and it's almost a fund of one, something of that nature, and that works to get the capital in, but then that might not be the preference for a broader range of investors thereafter. So it's also a question of, for a US manager, how do you want to structure your European investment? Are you really doing this very in the basis of, well, I've got a couple of investors who I'm going to bring in. They are rather peripheral to my overall focus of raising capital, but are very material in their own right. And I'll create their preferred structures. However high they want me to jump, I'll jump. That's rather a different approach to creating a more open-ended architecture that has more flexibility to bring on board investors from different European jurisdictions, investors of different profiles, and investors who might have different areas of preference or preferred structuring, preferred service providers, etc.
Last question, if you can do this reasonably quickly, is do you think it's possible either now or in the near future to have a situation where, with your use of AI and what you're developing, you can have some potential red flags being flashed up before the bad stuff happens, because you can plot something that's happened in the past. There's a recurring pattern that might raise a potential red flag, or is that not possible?
I think that the indicators, there are going to be more indicators that are more reliable. So we have a lot more tools in the toolbox. We can really learn from what's happened in the past. The skill, of course, is at this point to be looking at the infamous Warren Buffett phrase, when the tide goes out, we can see who's swimming naked. The flip side is no one asks tough questions when everyone's making money. So plenty of people have piled into managers, funds, strategies, FOMO, fear of missing out. Everybody's in this stuff. Plenty of large PE firms don't even have an administrator. Doesn't stop them raising capital, no valuation agent. What AI can do is really pull together data across a very large number of managers, look at examples of things that have blown up, and then give a little bit more of a predictive quality as to where we could potentially be going with future problems. So it's a super powerful tool with much better predictive quality than we have, but it's not always going to give you the magic lotto numbers.
Right, brilliant. Ending on magic lotto numbers is as good a place to end as possible. But I was going to say, we have a number of questions. You can stick around if you'd like to, if you want to contribute to these answers. But I see we've got questions in reverse solicitation, returns and mancos. If it's not your field, and it may not be, we happily put you back down to the audience, or you want to give a go at answering that. Any views on reverse solicitation or not?
I see one on Cayman and Europe, so I'll hang around for that one, but I'll definitely.
Well, let's do. I'll tell you, why don't we give you that one first, and then we'll let you go. Then you can make a cup of tea or a cup of coffee in Montreal, whatever you have in Montreal at this time of day. Take a Yorkshireman to Montreal. I know what you drink mid-morning.
Yeah, I think Simon always reminds me I've been here 20 years, but I'm originally from the north of England. There's a question from one of the Q of A. We've been told that it's increasingly difficult to use Cayman funds for Europe. Is that correct? The short answer is I think there is much more skepticism as to offshore tax havens from continental European investors. Much more skepticism than there are in other jurisdictions, but ultimately the number of investors who would not invest just because it's a Cayman structure are very small. But I think that can change from 2 or 3 reasons super quickly. Number one, global tax, money laundering, all of these issues, these offshore jurisdictions are always somewhat vulnerable. The Cayman Islands is a small town of 68,000 people. It's vulnerable in terms of its overall level of resource and resources if it was to be attacked by left-leaning tax initiatives. Secondly, I would say that the general sentiment against tax havens in Europe is I don't think we necessarily understand what some of the continental Europe perspective is. I always come back to the fact, obviously, I live in Montreal, so we speak French here. In English, a tax haven has a sense of almost protection in a storm. It's almost a positive. In French, the word is in paradis fiscaux, or a paradis fiscal. So a fiscal heaven, taxation paradise. And that is not a compliment at all. It's a very derogatory term. So certainly that's one of the reasons I think why France is just so negative to the typical stereotype of mojitos on the beach. Equally, of course, the German politician, locusts, all these sorts of things. And I do think also ESG comes into this as well, because on the S side of it, tax equality, income inequality, all very important things that are completely contrary to the notion of tax neutral or tax-free jurisdiction. So I remember when the 10 Commandments disappeared in 96. These things can come through very, very quickly if there was some sort of governmental change. But it's really questions about offshore tax havens versus having an onshore regulated jurisdiction in that sort of context and perception of offshore locales.
Brilliant. Thank you, Chris. I'll let you go and see you the next time. And Samantha, if you could read out the remaining questions, if you put Chris back into the audience, that'd be great. Thank you very much. Okay,
Um,
and I'll try and answer
right.
the other ones we've got. I see this. I think there are three others.
Yes. So the first one is it safe to use reverse solicitation?
That is a question that's come up many times over the years. When the EU Cross-Border Distribution Directive came in, which is I think was 2 or even 3 years ago now, there was talk it was not going to be safe as it was. But, and I think there was from all the conversations we've had with many people, a dip in the potential use of it. That seems to have passed. It seems to have got through that, and people using reverse solicitation seems to be as popular as ever, as we've been told on several occasions by US managers. If you have a good lawyer, you should be able to avoid the potential legal problems if something goes wrong, particularly if that lawyer then hires somebody in the jurisdiction where the investor is too, that can equally protect the manager's interests. So there shouldn't be, and there hasn't been in all the many years this subject has come up that we are aware of. We've heard one or two rumors of problems that have been swept under the carpet, but in all the years and years and years that this subject has been around and it's been going on, I don't know. There's been no public cases of a scandal happening and some manager suffering as a result. So yes, I think it is safe, but it's not, as people know, and probably the questioner may well know, it's using reverse solicitation isn't a strategy. It may be a perfectly viable way to sort of put your toe in the water if you're interested in coming into Europe, but it's not a long-term strategy. You do need then to either go down the private placement route or, as we were talking earlier, even conceivably going to the EU if you can see where your business is going in Europe. So that's the answer to one question. I think. What's the next
Yeah,
one
we've got
there?
a couple more. Why do European investors have lower return expectations?
That's something I didn't. I'm not saying that's 100% necessarily true. Came up in our research as being something that we've come across just now, but it seems plausible and logical. If it is true, to repeat perhaps what I've already said is that we have heard that one of the more prominent third-party major Mancos has done some research which does show this, and they're using that as to persuade American managers to come to Europe because, quote unquote, it's easier to access capital in Europe and the bar is a bit lower in terms of the expectations. If that is true, then we're into the guessing world as to why. I guess it would partly depend on where. Are you talking about institutional investors, the pension funds, and so on? Are you talking about family offices? I would very much doubt if family offices in Europe have got any lower expectations than family offices in the US or Asia or anywhere else. Do public pension funds? Chris alluded to the ESG thing. Certainly, there's a lot of, amongst the big, large public pension funds, there's a lot of decision, a lot of parts that go into the decision that go beyond pure performance. It goes into things, as he said, about ESG, goes into some of the stuff that goes on the structuring side of the fund, and making sure that decision, in inverted commas, is politically correct in one way or another. So that is very possible. That is the case, but I can't say more than that. So that's that. Any other questions?
Yeah, so our final question is, can we use a Manco if we're not planning to have an EU regulated fund?
Very interesting question. And that's kind of one of those out of left field questions that you wouldn't necessarily expect to get. Interesting. The reason for using a third-party Manco stroke AIFM is because you want access to Dublin or Luxembourg and you want to go through the full compliance route. You need to do all this. You need to jump through all the hoops under the AIFM directive. That's the reason. However, I guess I know whether the question is implying it or not. These Mancos now offer a lot of services beyond that, beyond the core function, I should say. And I'm sure if that person who asked that question is in the States, if that many of those Mancos have offices there, I'm sure they can help them out in different ways with things they need, whether it be capital raising or some advice on entering the European market. Do Mancos in Dublin or Luxembourg work with Cayman Funds, not formally, but I'm sure they work with the management group behind that, or might work with the management group behind that in some regard or another. It's one of those things that perhaps is worth pondering. I probably can't do better in answering that question than that. So, well, we've sort of, as always with these things, we've gone through nearly an hour, as you know, rapid rate. So thank you all very much indeed for joining us. And hopefully see you the next time. As Samantha mentioned, we will be publishing the results shortly, and we'll be mentioning further discussions in this series, probably starting from the late summer into the autumn onwards. So hopefully you'll be able to join us again for the next one of these. Goodbye.
Bye-bye.